Hello, my name is Dennis Brooks. I'm a graduate student here at UAB in the COLAT Tutor Lab that is within the COLAT School of Business. You can reach us on email through the COLAT Tutor Lab at uab.edu email account, or you can set up a Skype session with us at COLAT Space Tutor and receive a Skype tutoring session. Chapter 9, which is what we're going to discuss now, concerns itself with current liabilities. Current liabilities are debts or obligations incurred by your company that are due within 1 year or within the company's operating cycle, whichever is longer. Typically, the 1 year is going to be longer. Most companies do operate on, honestly, I don't know a company that operates on a longer than 1 year cycle at max. Most operate quarterly, at worst annually. I assume there has to be somebody out there who does it on a longer cycle, but I'm not sure who. What I have listing here are a list by no means definitive of many of your current liabilities. One thing that is helpful in accounting for your payables is that the related expense is often going to have the exact same name, except it says expense instead of payable. So accounts payable. Accounts that your company has incurred from other companies offering you a credit. Since it is a payable, it is an expense that has been accrued but not converted from a payable to an expense yet. Sales tax payable. Offsetting account is going to be sales tax expense. Notes payable that are due within the year or your company's operating period, whichever is longer, are going to be notes payable expenses. Payroll payable, payroll expenses. You know what these are just by reading the name of the account. Unearned revenue. Unearned revenues are revenues received in advance from your customers for future products or service. One of the most common examples is a magazine subscription. Your customers pay for their magazine subscription in advance, and as they receive your magazines, your company gets to receive an equivalent amount of revenue from that unearned revenue. So what you would be doing is debiting the unearned revenue and crediting your revenue account. Warranty, the seller's obligation to replace or correct a product or service that fails to perform as expected within a specified period. An example of a service: you go to get your car fixed at a national retailer who does car repairs, and they fail to perform the service that they say that they do, and you discover at a later date that they've not done so. You return to the place of business of that national retailer, and you have them perform the service. So that would be an example of failing to correct a service that you expected to perform differently than it did. We're going to talk about accounting for contingent liabilities here. There's 4 possibilities. You have a probable contingent liability, and it has a estimatable or estimable cost associated with it. You would then record a liability in your liability accounts to recognize that contingent liability. This could be anything ranging from storm damage to lawsuits, numerous things. Contingent liability, where the outcome is probable but non-estimable, you would disclose it in the notes of your financial statements. Management has to write in their financial statements to make notes about anything that they feel is important or relevant to a reliable user or a user who would make decisions based off of information available in the financial statements. So management often uses those notes to give information on things that may be happening or are happening that they want you to understand why they're using this estimate amount or why they're doing something a certain way that you may not necessarily agree with. Now, if you have a contingent liability where it's possible but there's no monetary cost involved, you would disclose it in your notes. Again, as we talked about, management does have the right to disclose information in their notes to, again, help reassure a reasonable investor that things are as they are stating in their statements. Now, if the contingent liability that has come up is remote, there are no disclosures needed. There's no chance. If it's a remote chance, it's very unlikely that it's going to happen, so you don't have to even make a note of it. The 3 steps of making a decision on contingent liabilities. Future event is probable, likely, and amount can be reasonably estimated. Record the event as a liability. The future event is probable, but the amount cannot be reasonably estimated. Disclose it in the notes. Same as if an event is possible, you would disclose the event in your notes. You would not book a liability on it, but you would disclose it in your notes. Future events is remote. No disclosures are needed. Potential legal claims are very interesting in this chapter for you. They follow much the same risk as accounting for contingent liabilities. If your company is embroiled in a civil legal litigation, you would only disclose it if payment for damages is probable and those payment for damages can be reasonably estimated. If that is the case, you would then book a liability in your liability section of your financial statements. If the pending litigation damages cannot be reasonably estimated and is either less than probable but still reasonably possible, you would disclose that liability in your notes. And again, as above, where if the chances are remote, you don't even disclose it. Most of this chapter is primarily definitions and concepts that you have built on since chapter 1, and it's a lot of journal entries, which basically is you're setting up your payroll payables and you're setting up you're removing a payroll payable from your liability side and turning it into a payroll expense. It's just journaling. So there's not really a lot that I can go through here that your book does not do as well or better than I could. And due to that, due to chapter 9 being primarily conceptual in definitional and journal entries, no Excel problems were done. I realize this makes for a very short tutoring session, but chapter 9 really is just concepts and definitions of what you have been learning since chapter 1, and the new things that I've pointed out in the definitions and concepts are really fairly standard, and then you just have to learn how to journalize the entry, and your book does an excellent job in chapter 9 of noting how those definitions or how those journal entries are made. Again, my name is Dennis Brooks. I am a graduate student here at UAB. I'm a tutor in the COLAT Tutoring Lab in the COLAT School of Business. You can reach myself or any other tutor at COLAT Tutoring Lab at uab.edu, or you can arrange for a Skype session at COLAT Space Tutor and have a personalized Skype tutoring session if needed or necessary. Good luck on chapter 9 in your test, and I'm going to close this now.